Okay, hey guys. We're gonna be looking at um call options and put options. I don't think I'm gonna do more videos on capital markets, but this at the end of the day is the hardest topic in my opinion because it's similar to, and I was referencing to this. It's similar to stats in the independent and paired t-test where you have to choose first before applying a formula. So let's just quickly look at what call options and put options are. Okay, so I ended up switching to my iPad because it's a lot easier. I wasn't about to type everything out. This is gonna take like 3 hours. So, the main thing you have to remember between call options and put options are what they do. So, call options, they give you the right to buy, and put options give you the right to sell. So a good way I remember this is you call your dog back. So um it's going to you. So if you have the right to buy it, you're able to recall it. And that's essentially what it means. The right to call an asset means the right to buy an asset. And then putting is like putting something on the market, putting something on eBay. So it gives you the right to sell. Um, and just a clear distinction here you have to make sure. Right now we're looking at it from the perspective of the buyer, not the perspective of the writer. So I'll make the distinction a bit clearer later because it gets a bit complicated. But right now you have to know that calls is buying and puts is selling. So next up, when do we know when to or how do we know when to exercise this? So the main thing you have to know is that these things have both strike prices. Oh my God, my spelling is horrible today. Um, let's put this here. Price and your premium. The strike price is essentially the price you set at where you want your option to be. So in this case, for calls, it's the price we're calling an asset. And your premium is the purchase price. And then the way you know when you're gonna purchase this or you're gonna exercise this option, and let's put it also in red, is if share price is greater than your strike price. Or less than or equal to, but frankly, just it's better if it's greater than. So then, uh, conversely, here your strike is the price for putting an option, and your premium is your purchase price. That's easy. And this is exercised if your strike price, or sorry, your share price is less than your strike. So how do we actually remember this and how does this actually look? So the way I see it is that calls are similar to a subscription service, whether it is Netflix or Hulu or HBO Max. Why? Because it is you're renting out something. So say you have a trial, um, and let's say you're paying. Let's ignore the premium. So you have a trial, you have a trial, you have a trial, and then suddenly your month is over, and it asks you, "Hey, do you want to do you want to purchase us? Do you want to subscribe to us?" And there you decide whether you want it or not. And the market on call options works a bit similar in a sense that, and let's make a little graph so you guys can actually see this. So say your stock is right now, so 90, let's say current price. And your thinking is that, hey, and let's change the color. We're bullish in this case. Bullish means we think that the stock is going to go up. So we say, hey, I am pretty sure this is your bet. I'm pretty sure that the stock is going to rise up at 95. So what do you do? Because you can do one of two things. You can either buy the stock at 90 and hold it until it gets to 95, but then you'd have to invest a lot of money. So say if you were buying what, like 10 stocks, that would be $900. So instead, what you can do is place a bet essentially and say, hey, look, Mr. Option seller, I am gonna pay you $2 and you're gonna give me the stock for 3 months. So again, reverting back to our trial run. Say you tell Netflix, hey, I'm not sure I'm gonna like this, but I'm willing to bet that I am. And you're gonna give me a 3 month trial, and if by the end I like it, I will subscribe. So going back to this, so say you say, oh, I'm willing to bet that the stock is gonna go up to 95, but I don't have the right amount of capital to purchase it at 90 for the amount of stocks I want. So you say to this guy, I am willing to pay to, let's say instead of pay, let's say bet, so it's easier. I'm willing to bet $2 that stock, let's put P stock, that stands for stock price, is going to be greater, or yeah, let's say P stock is going to be greater than 95. So how does this all unfold? So you're currently at 90, say in 3 months, you're suddenly like, oh my God, this stock got to 95. I have a contract saying, hey, if the stock gets to 95, I can buy it. I have the right to buy it. So here we got to 95. So we were betting $2. So we have 95 minus 90 because sorry, not minus 90. And this is what I was referring back to. Um, sorry that I'm about to show you an example with losses. I will make sure that corrects it. So we buy it at 95 and the market is also buying it at 95, and then we subtract our bet. So this is -2. So why did it give us a negative? And this is reverting back to this, why we want it to be greater than. And sorry, I said 95. I didn't realize that we were going to be adding the premium. Just focus on the fact that this is how it works. So here you had the right to buy, and once you got to the 95 you wanted, you went ahead and bought it. And what did you do? You sold it because this is the market price. So you had the right to buy at 95, and when the market was also trading it at 95, you decided to exercise your option and buy the stock. So how does that formula actually look and why you don't want an equal to? So ideally, what you'd want is suddenly the market starts trading at, let's say, 98. So this is market price. So what you would do is say, hey, mister, I have my bet. I bet you the $2 that I could buy the stock at 95. So you go ahead and purchase the stock at 95. Here you went ahead and, or sorry, exercise your option. Then you have your bet. So you have your bet of $2. So let's go ahead and put this here. So you have your -2. But You bought the stock here. You bought the stock here at 95, but the market is selling it at 98. So what do? You go ahead and sell it. So you have 98, so you sold it to market. So here we have 3, and this all totals out to $1 of profit per stock. So that's essentially, and I'm sorry that the example got a bit confusing. I didn't mean to show you an example with losses, but that's essentially what this is. You're literally betting this amount that the market is going to behave a certain way. So what happens if, say, suddenly the market decides to say, you know what, I don't like you, and suddenly the price drops to 80 after 3 months? Then going back to our subscription service example, you tell the subscription service, look, I don't want your product. I'm good. I liked HBO better than Netflix, and I don't want to subscribe. So you just let the options expire. So it's in Netflix's case, it is a free trial. Here, going back to it, we have our bet. So our cost, if expired, is $2. But this, and the reason people buy options contracts is because imagine if you would have bought your stock at 90 instead of making that bet, you would have lost $10 each stock. So again, if you bought 10 stocks, and by the way, the contracts go 100 times bigger, but 10 stocks is just easier for me to do the mental math on it. You would have lost $100, and in the grander scale, that could have been 100,000 or 10 million or 100 million. Well, here with 10 stocks, the most you would have lost is 20. So that's why people go into options contracts, and that's why people do these bets, because you can have a low amount of capital invested, and your profit could be pretty big. So the and by the way, we switched. We're now looking at puts. Um, the way to think about puts, it's kind of like Apple Care. So essentially, you're just paying an amount of money to, in case something happens. So puts, you can think about them like a protection, but at the same time, just remember that you don't have to necessarily own the asset um, in order to make a call or put. I will explain that a bit more, but let's just get down how does a put look. So again, using the same numbers, say right now the market's trading at 90. So this is your current price. And by the way, I made sure this time we wouldn't have like a negative example, because that could have tripped up a bunch of you guys out. So say your current price is 90, and you're like pretty sure that you're bearish on the stock. Bearish means negative, and you're sure that it's gonna go down to 85. So again, you make a bet. So you tell this guy, similar to what we said this here. So I am willing to bet $2, and that let's use the same. Oh, yeah, P stock is gonna be greater than. I'm pretty sure. Give me 1 second. Sorry, I got confused. That let's say that my bet is gonna be greater than the stock price in 3 months. So again, let's look at what the market does. And please remember, you do not have to have the actual asset in order to participate in the options trading. This is just purely a bet. So let's say suddenly, so you have your $2 bet. Let's say suddenly the market just decides to upend itself and just like completely crashes. So what are you gonna do? So let's say you have 60. So this is price in 3 months. In 3 months, let's just label these properly so you guys are clear on it. This is your bet. So what are you gonna do? It's pretty simple. You have your right to sell. So you have your 60. You have your premium, which is -2, which is what you bet. What do you go ahead and do? So suddenly this is at 60. So you go ahead and purchase these options at 60. You're like, by the way, by what I mean by this is you go out to the market and say like, hey, I'm gonna buy 10 stocks at 60, I'm gonna spend the $600. So you have these at 60, but you have your right to sell. So you go to the guy you bet against and you're like, hey, I was right. Give me my $85. So this is sold at exercise minus this is the market price you bought them at. You bought, and this is just your premium. So this is your bet of $2. So here on each stock, you made 15 in profit on the stocks alone. Look, because you purchased them at 60 from the market and you sold them to your better, to the guy you were betting with at 85. And you just had to pay the $2, which is your bet. So you have 85 minus 60. That's, if my mental math works, I'm pretty sure that's 25. Yeah, that's 25 because it's 60, 70, 80, 60, 70, that's 25. Okay, anyways, it doesn't matter. So you have a 23 profit. So that's a little rundown on how these work from the perspective of a buyer. Now, let me I'll clear this up a little bit and we're going to look at from the perspective of a seller. So the thing you have to note here, and let me just, is that in this case, you are the writer of the option. So the thing about writers is that they always have at least the premium fixed. So what does this mean? So if you recall from here, you were the guy or the person buying these options and you were betting. You were betting. You were the one that was betting. In this case, you're on the other side. You're looking at the guy telling you, hey, I'm willing to bet you this, that the stock is gonna move this way. So you're always gonna have your $2 bet. Let's just put bet. Let's just put secured. Or like you're always gonna make as let's put as made money. You're always gonna have those $2, no matter what the market does. You know, you're always gonna have those $2. The only issue is what's gonna happen, or how much more money you're gonna lose. So $2 bet made money. That's perfect. So how does this look? So again, and I'm going to use the highlighter mostly for this one because we're using the previous example. So let's say at current price of 90, some guy goes up to you and tells you, hey, I'm willing to bet you that um, that the stock is going to go up to 95 and above. And when that happens, I'm I have the right to buy from you. So that's what the guy is telling you. So what happens if this guy is right? Say the market is at 98. So you're at 98. So you have, and like this guy's like, hey, I was right, give me my money. So what you'd have to purchase at 98. So you have to purchase at 98 from the market. So you have to purchase at 98, and this is negative. Then this guy, since he bet you, ooh, this is not cooperating. So you're selling it to this guy at 95, but you're making the premium back. So, and by the way, this is still a bit confusing for me, but I'm like 90% sure this is how it works because it logically makes sense. But again, as I always say, do your own research. Because I'm not a teacher, I don't get paid for this, so I don't have to be perfect. I'm just trying to get you guys up to speed. Um, so you purchase at 98 from the market, and then you have to sell to this guy at 95 because that's what you agreed upon, and that's why you're having your bet. So here it would be, and this is where it gets confusing because I'm not sure how much your loss is, because it doesn't make sense. Um, but I'm using the teacher's formula because it says negative SD minus X. But I am pretty sure here, since you bought at 98 and then you had to sell at 95, you'd have a $1 loss per stock. But I don't know why the teacher has a negative sign there. Again, I'm not sure, but just know that you had to purchase. Oh, no, it makes sense. This is supposed to be a plus because you purchased at 98, um, sold at 95, so this is -3, and then you have your bet of $2 that you made, so you had a loss of $1 per stock, and say you were buying 10 stocks, that's $10 of loss. But what happens if you're right? If you're right, if your side of the bet is correct, you incur, or sorry, this guy, the guy that's betting against you, he just let the options expire. So say if the market goes down to 80, he's just gonna let that expire, and you have your $2 as profit. $2. Oh God, that's a horrible two. S2 is profit. And again, if this is again like a strategy, you can buy protections for when you buy an asset through this, or but in this case, if you're just looking at the options, if none of you, whether the guy you're betting against or yourself, if none of you have the asset, you're making $2 profit. Well, here this is your loss. And by the way, this is like I'm pretty sure it's correct. I just got a bit confused by the teacher's formula, but this is how it works. So again, just to reiterate, you'd have to go out and buy at 98. You'd sell this guy at 95. You have your bet, and this is what you made, or in this case, you lost. So writing a put is a bit more complicated. It's like it has a lot of layers. So again, just bear with me here. I will probably like make a couple of mistakes as I go, but in general, I will explain. I will explain it correctly. So a put, if you remember, is the right to sell. So if you're selling the right to sell, what does that mean? Is that you have your obligation to buy. You have the obligation to buy from a person. So how does this look? So this is where it gets a bit confusing, because the losses or profits you make are mostly based off of like market valuations, not necessarily like for example here you actually had to go buy the stock because this guy would exercise, or like the guy you were betting against would exercise his option. So you'd have to go on, purchase the stock, he'd go on and sell it and make a profit. While here it is mostly based off of market valuations, and I'll try to go a little bit more in depth as to why. So essentially, again, say the current price is 90, and a guy bets you, hey, I'm willing to bet $2 that the price is going to be 85 or below in 3 months. So what happens? So in 3 months, the price is 60, and the guy goes ahead and buys the stocks from the market. So let's put better buys stock at 60. So this is 60. So what are you left with? And let's move this a bit more. So you have the obligation to buy it to this guy at 85. So your obligation to buy, because you sold the right to sell. That means you're obliged to buy. So you have to buy it at 85. And here's where it gets like a bit confusing, because here you're actually dealing with the stock, while here it would be kind of like dumb for you to go ahead and just dump the stock. Like you have to um you have to buy it at 85 and it's valued at 60. I don't know why you'd sell it immediately. Because you could probably just hold it and see if it regains any value. But to be fair, if it tanked this much in 3 months, I think it might be tanking a little more, and it's easier to just dump it. But honestly, just I don't know. This is very like subjective of um, each person. So here you have that you had to buy it at 85. Let's say you sell it. Let's say you're like, okay, this is just gonna crash. This is like like a horrible recession. It's gonna probably go down to 20 in 3 hours. So let's sell it at 60, and you made your $2. So you'd have it here. It's 25, so you made what, 23? Negative two, or like you incurred a $23 loss. And what happens if the better was wrong? Let's say the price ended up going at 98. He's the better is not going to exercise your option, so you're not obliged to buy, and you're going to make your $2. So you're happy that you made your $2. And that's a little introduction to calls and puts from both buyer side and the writer side.